Morning. Can you hear me up the back? All right, great. Well, welcome to week 5, and we're looking today at modern portfolio theory. So, just to take you back, the cost of capital, which is what you need to get a return for your money, what the suppliers of capital will expect. So that's why it's called the expected rate of return, which in turn is equal to the discount rate. That's made up of the risk-free rate plus the risk premium. So what we're looking at today is how do we combine a group of assets together to give you a portfolio. What you like really is more return, less risk. You want to come closer to that point where you get the highest return for the least amount of risk. And that's the point of modern portfolio theory. So we look at that, we look at the theory, and then we'll look at some implications of modern portfolio theory for investing. So a word from a sponsor. This is for the Finance Association of WA. They run a very good program. Even if you don't intend to go to this program, it's a good organization to join. They tell you a lot of things that we don't tell you in the lectures, but that is really important to prepare you for the workforce. So any of the courses they run, I highly recommend. And this is one of their flagship events of the year, the Business Breakfast. It's a bargain for $20, I'll say. Okay, just in relation to what you're doing in terms of this theory, I like to relate it to make sure that you can use everything. It's not just for your work, but also for yourself. So one of the things you need to think about is your own portfolio, your own investments. And here I want to point out to you that your assets consist of more than just the shares that you own. It's common to think of investments as just shares and doing a return. But really you've got 4 kinds of categories of assets: your human capital, which is connected with your employment income. And so here is how specialized is your skill. The kinds of things that you need to do is what is the risk attached to your particular set of skills that you have, your human capital. How specialized is it? What are the barriers to entry? And even here there's a kind of a trade-off. Generally, the better you are at whatever you do, the higher the return. And in fact, in the kind of world we live in, if you're the best at what you do, you get outsized returns. The kind of returns that you do are significantly disproportionately higher than the next best person. So we live in a kind of a winner-takes-all economy, which I'll put up some readings there to, because this is quite an interesting concept. But you need to know about how specialized is your skill, what kind of investments you need to make over the course of your career. And again, I'll put that up in some recommended readings, and what might be the barriers to entry. Because the high income that you earn won't be a function just of how good you are. It will be a function of your barriers to entry. Every every high-paying job, it's the money that they get isn't because they particularly need it, or this is something that society wants, but it's a function of the supply and the demand. So we know that medical specialists earn a lot of money, and you might think, well, they deserve it because of the training that they do. But actually the functions that they get, the money that they get, isn't a function of the extent of training, however hard they might train. It's a function of the barriers to entry into those particular professions. So if you're, say, an ophthalmologist, you train, you get the best training in the world, and you come to Perth, you can't just walk in and become an ophthalmologist. You have to get accepted by the group of people, and they're tightly regulated. So that's one of the reasons why ophthalmologists make a lot of money. It's the supply is low relative to the demand of those things. But that's true of anyone. I'm just picking them as a typical example, but that's true of just about any profession. Your homes as well. So that's a significant investment in your home. And last year, or was it the year before, I made one assignment was, should you invest in a house? What kind of investment should you make? And some of the assignments were pretty good, so I'd recommend that you read those. They were. The other thing in Australia is the superannuation, the government-mandated retirement funds. So from the 1st of January, 6 years ago, employers pay 5%, 14% of salary to the individual's retirement fund. And this, for most people, will be where they get most of their retirement income. What's surprising about this is that if you ask people which fund they invest in, they have no idea. It's quite remarkable. But a lot of people don't even have an idea of what their total superannuation fund is. It's the extent to which people don't pay attention to the, a fairly significant fact is quite remarkable. And again, here you have some things like regulation risk and appropriation risk. So one of the rules that you have, people are relying on their superannuation, but then there's a risk that the government might be changing the rules over time. In fact, that's almost a certainty that the rules will be changing over time. So it might appear to be certain in some sense, but it's not. And then there's the other personally directed investments. So I just wanted to make sure that you get a sense of that even you as investing, when I talk about modern portfolio theory, you actually have a portfolio of investments. In the course of my lectures, I often talk about, and it's just the nature of things, I'll point out some experts and I'll point out how their weaknesses, the flaws, I think, in their logic, etc. And so I might come across as being somewhat cynical and know-it-all. So I just want to counter that impression here by giving you an example of someone whom I think is really good and really worthwhile reading. How many of you have heard of The Barefoot Investor? Oh, quite a few. Great. What do you think? Anyone who's good? Yeah. So the thing about this is that he's written, and I recommend this to all of you. I think it's just because, as I said, a lot of people, even after you take a course in finance, it doesn't alert you to your own personal issues, your own personal financial issues, that is. So I highly recommend reading his book. It's a best-selling book for good reason and for worthwhile reasons. I think it's... And he does it in a way, so one of the things I like is that he does it in a way, it's not about a get-rich-quick scheme, it's about getting control and doing it in a way that is easy for people to implement. Okay, I want to ask you, now this is a risk and return kind of thing, there's no right answer, right? And I'll explain why, but I just want you to think, this will show up an aspect of people's thinking. So if you're like everyone else, maybe you're special in this regard, or maybe. So you have $1,000 and you must pick one of the following choices. You have a 50% chance of gaining 1,000 and a 50% chance of gaining 100 than others. You have a 100% chance of gaining 500. Which choice would you take? Now, can you write it down and just bear it in mind at least? Okay. Yeah, go ahead. B, right, thank you. So you have $2,000 and you must pick one of the following choices. You have a 50% chance of losing 1,000 and a 50% chance of losing 100. You have a 100% chance of losing 500. Which one do you take? All right, but which one would you read, the first time you looked at it, which one did you want to take? Still B. Very good. I said very good. It doesn't really matter. It doesn't matter whether you picked A or B. So you have a 100% chance. Who'd take A? Okay. So most people actually end up, unlike. Sorry, you're not. Joseph, still Joseph. I asked you last week, sorry. Most people would say B for A, they want a sure thing, they get 500, and other people would take, for this question, they take A. Now, you've probably, all of you, noticed in the first one, you have $1,000, and in the second, you have 2,000. Right? So if you pick, in the first one, if you pick 1,000 plus Joyce B, you get 1,500. So for you to take, if you pick A and B, you're still 1,500. So you're consistent in your preferences. But most people would take A. And the reason why they take A is because the thought of losing that money really hurts. So people don't look, the point I'm trying to make here is that people don't look, everyone's risk averse, but losing money seems to hurt more than gaining money. So this is what's known as the endowment effect. And the endowment effect can be shown in quite a good way. If I came in here and I gave each of you alternatively a mug and a pen, and then I asked you to exchange it with someone else, in that short period of time, you would grow attached to your endowment, which is the mug or the pen that I gave you, and you'd ask for more in return. So you wouldn't be indifferent between the two. So what you have, it's a sort of a psychological thing, but what we have, we look to protect rather than to. Which has some implications for investment behavior, and I'll talk about those in the next couple of lectures. Okay, going on to talk about modern portfolio theory. So we have here the poor billionaires, 430 people fell off the list of the world's richest. So the question here is, what happened here? I mean, these are the richest people. What kind of advice could they have taken, perhaps, to have prevented this kind of a loss? So, in helping us, we have the two giants who've come up with this modern portfolio theory, James Tobin, who got the Nobel Prize in 1981, and Harry Markowitz, who got the Nobel Prize in 1990 for a paper he wrote when he was 25. It's a bit of a joke. So he was asked by the reporter to explain his ideas, and he said, well, you know, don't put all your eggs in one basket. And then the next day there was a newspaper report saying, Professor gets Nobel Prize for saying, don't put all your eggs in one basket. Someone else then the following day put up a cartoon for a doctor. A doctor wins Nobel Prize for saying an apple a day keeps the doctor away. I find that funny. No one, students don't find that funny. I don't know why. The person that was Harry Markowitz, who had this don't put all your eggs in one basket approach. So two people came up with this idea. But what he did is extend this a bit. He said, don't put all your eggs in one basket, and gave an additional insight, which I'll tell you. So this gave rise to modern portfolio theory and something called the capital asset pricing model. So that was Harry Markowitz's things. And here you can see that it's still being used. So we had last year the Independent Economic Regulation Authority asked me and a couple of other people to look at this, whether we're paying too high a gas or what should be the recommended rate of return. And the kind of guidelines they came up with is the capital asset pricing model. So the Sharpe-Linton capital asset pricing model remains the dominant asset pricing model used to estimate the return on equity. Actually, I was quite surprised that it's still used in this way. And we kept on arguing about very small points of details, which I thought was, which I was a bit puzzled by. And I'll talk a bit more about that next week when we focus a bit more on the capital asset pricing model. But why am I saying that? I'm saying that because it's actually quite controversial. So we have these people saying, is modern portfolio theory dead? How modern portfolio theory has failed investors, and this is following the financial crisis. And here you have Charlie Munger, who's Warren Buffett's right-hand man, who's believes business is not a science, it's an art form. He doesn't believe in scientific formulas such as beta and modern portfolio theory, and he says, beta and modern portfolio theory, none of it makes any sense to me. How can professors spread this nonsense that a stock's volatility is a measure of risk? what I'm about to teach you, a lot of people think is rubbish. And quite, it's hard to say that he's not doing well. He's doing very well. So what I want to show you is some situations where modern portfolio theory actually has some insight for us. So here we have Greg and Karen T, who had planned to use the proceeds from the property sale to fund their retirement. They pulled their home, and it turned out that things didn't go well, so they pulled their home off the market in Port Hedland after just one viewer inspected the house over 3 months. So what we'll look at is, what, if any, mistakes did Greg and Karen make, and could they have been avoided by looking at modern portfolio theory? On the other hand, we have Matt and Kate, who went into investment property, and they were the Investor of the Year 2012. And they said, at just 24, so not much older than you, they've achieved more than investors have in a lifetime. They've shown significant skills across investment strategy and have seen amazing results, and they have a plan. They also have, they've obtained knowledge from the right sources and tapped into their experience to strengthen their decision making. You can't beat that. So we look at, what, if anything, did Matt and Kate do right, if you're thinking of getting into the property market? So we're looking at professional fund managers. So as Dilbert saying, I'm starting a mutual fund for investors who aren't bright enough to know the alternatives. So it must be a huge market, otherwise most people would invest in index funds. And he says, what's an index fund? And this is, you're making me wag too hard. So the point is, a lot of people allocate their money to managers who say that they're going to give them higher returns. How valid are these claims, and have we any reason to believe that they can earn these returns? So the kind of thing I'm looking at is something like this. We have a star trader whose stock fund has attracted $10 billion in 10 hours. You say, put up your shingle, and you say, give me your money, and I'll invest to make higher returns. And you're so credible, you're so believable to these people that you can attract $10 billion in 10 hours. Now, what I want you to think about, how likely is it that it's true? And the other thing I want you to think about is, what could this person possibly know that you don't, or that anyone else doesn't, or the average professional investors? Because to attract $10 billion in 10 hours, people must think he is better than anyone else. He must know something that no one else knows. What could that possibly be? How does this work? How do you get people to give you money? Because that's what it is if you're in investing, getting people to give you the money. Turns out that it's quite difficult. So we see that out of 1,034 large capital funds, so this is large companies, funds investing in large companies, benchmarks against the S&P index. So this is the index fund. So to follow an index fund, you don't try to beat the market, you just put your money in the index, which you get low-cost funds. The managers don't try to beat the market, they'll say, we'll give you the index return. Just 19.7% came out ahead. Not one of these managed to repeat the feat in each of the next 12 months. So that could be by chance. Okay. And none of them managed to beat the... Here you see some latest, that was from last year. This is from the latest returns from March 2019. You see here the funds outperformed by the index, by the peer group. So, and you have different periods. The 1 year time frame, 3 year, 5 year, 10 years, and 15 years. And let's have a look at this focus of this one over here. You see that over a 1 year time frame, this was last year, fewer than 20% beat the market. Over a 10-year time frame, now 10 years is a long time. You might think if you're good or anything, you've got the money for 10 years, you should be able to beat the market. Hardly any, a small fraction, managed to outperform the index. So just by putting your money in an index, you would have got better than the vast majority of fund managers. And this is the same thing, more or less, the cumulative average fund return relative to the benchmark. You can see here the same story. If you try to go to an active fund versus just a normal fund, you find that they do better. The benchmarks do better. So then you have another class of investors. You have these, what's known as a hedge fund. So what a hedge fund is, what a hedge is in finance, is an asset that is uncorrelated with another asset or portfolio on average. Okay. So if let's assume you're let's use a sporting analogy. This doesn't really work out. Okay, let's say you've got the Eagles and the Dockers. Right. So, and let's assume that when the Eagles go up, the Dockers go down. Or, happily as it happens, when the Dockers go up, the Eagles go down. That happened over the weekend. So if you're a Dockers fan, you had a great thing because you had a high return. The Eagles went down and the Dockers went up. Now, if you like both teams, though, you'd be hedged. You'd have been hedged. You'd have had a normal return because one team went up, the other team went down, lost. So that's what I'm talking about, a correlation between the performances. So that's what a hedge fund is. And a hedge fund manager says, we can get you a return, a positive return, anytime. Regardless of what the market is doing, we are smart enough, we're good enough to be able to get you a positive return, or at least not lose your money. So do they, and they charge you extra for it. But it turns out that even these hedge fund managers don't do that well. So you see the hedge fund, the Standard & Poor's index had a total return of 21.8%, and the hedge funds on average gained only 8.5%. Significant underperformance. So this is what a hedge fund is: an alternative investment, protecting investment portfolios from market uncertainty while generating positive returns in both up and down markets. Now, how do they do this? They try to do this by investing in assets that you can't get into. Because if everyone could get into, everyone could be a hedge fund manager. So the premise is they try to get into what's known as alternative asset classes. And these alternative asset classes are ones where if the rest of the market is going down, then they will be going up with that. Now, taking back to that Dilbert cartoon, remember this? So this is what investors are willing to pay for people who promise this. Investors are willing to pay 22 over 20. What this means is, of that $10 billion, the hedge fund manager, so remember that $10 billion that he got in 10 hours? Well, he's made 2% of $10 billion already, because he takes it as his commission. And then if he generates any profits, he'll take 20% of that. So that's what I mean by 2 and 20. So even if he does nothing, even if he doesn't beat the market, he still generates 2% income of that, 2% of that investment. But their performance isn't doesn't match their. It seems to be you seem to be paying a lot for performance that really doesn't even beat the market. So as Warren Buffett says, why pay the high fees? And he makes a point. He says that when I first wrote this, I thought, oh, yeah, maybe. But then I think there is actually something to this. That wealthy individuals, pension funds, college endowments have great trouble meekly signing up for a financial service that is available to people investing only a few $1,000s. This is true of universities as well, I find. If I look at the universities, the vast majority of the universities would have done better by investing in an index fund, their money. But yet they insist on, or they seem to like to pay fund managers to do it for them, who get worse returns. And I've sat in on these meetings, and the fund manager tells us, the market was really volatile. And then I point out, I said, but you said that you would do well in a volatile market. They said, but this was in a very unusual period. Like, it's always an unusual period. But still, why do the universities do this? And it's the academics within the universities that have done this research which shows that they outperform. So you can have a look over here, a multi-asset portfolio. You have, if you look at large US equities, small US equities, and over a 3-year period, the large US equities would have the worst performance is minus 37%. The US bonds there, the worst performance is 4.39. So I can see here investing in bonds won't give you high returns, but it preserves your capital in the worst periods. So you're making a trade-off between security and return. Okay, so why do people give their money? So let's go through. This is an example of the kind of person. So this is Dalton Street Capital. They shuns traditional investing for quantitative model. So my question, how do you know? As an investor, how do you know to trust these people? Do you remember that example I gave when you were crossing the river? There's some crocodiles, and you have a guide who says he'll take you across there. Now, there's a 10% chance that you can get across, a 10% chance that you'll get eaten, and a 90% chance you'll get safe. But this person says, I can eliminate that risk for you. You come across, and I'll take you. Your friend goes across, you take the cautious path, you go to the bridge. Your friend takes this tip, gets across over the other side, and he says, you should have paid. It's safe. But how do you know? They have to tell you. They might say something like, we've got a track record. And this is what these people say. But they also have to convince you as well. They have to look the part. If a guide came there and just didn't look very credible, was dressed in rags or something, looked a bit impoverished, looked kind of thing, you thought, can he swim? Can he see? How do I know? So a large part of investment is about how you project. And for this, I want you to look at these people. Have a look. Have a look how they're standing. They're confident. We know. We do maths. That's what they say. We're mathematicians. Maths. So this is all part in finance. This isn't a mere thing. It's not a mere aesthetics of theirs. It's quite a deliberate thing to project a particular. When you go to a business breakfast, you'll see all of you will be wearing these sharp suits and things. That's what you're doing. There's a Way of Seeing by John Berger. He died last year, but I recommend it. The book came out in the 70s. But if you want to see the impact of this, then you should. I highly recommend it. It's got nothing to do with finance, but it's got a lot to do with art and how people project and the value. So it'll open up your eyes to presentations. So they say they want to prove to local investors that quantitative factors and analysis can deliver better returns than relying on traditional investment research and stock picking. Like, you know, there's thousands of people around the world saying, ooh, let's do some quantitative analysis and maths. And they come up with this. So with this algorithm, we only bring in actual figures of volatility and liquidity and forward and rearward looking actual numbers. The firm looks to capitalize on a behavioral bias between the US and Asia Pacific markets. And they kick off an absolute return fund. So it's called an absolute return because they promise you absolute positive returns in all market cycles. The underlying model draws on quantitative principles as well as behavioral finance. So it's impressive. No? And you think they're all maths, they've got maths degrees. So, but it's a competitive market. How likely is it that they know? So the fund, which target investments that want returns, aims to hold about 50 investments in underlying securities across markets, including Australia, Singapore, Hong Kong, Japan, Korea, and Taiwan. It employs derivatives and future strategies to take advantage of market volatility. We believe we have a deeper understanding of interrelated market behavior, and we are capturing that through the strategy, he said. Mr. Selvaratnam. But he asked him, how do you do it? And he says, oh, no, we're not telling you that. This is another tough kind of language here. It says, I'll bring out my black box if you show me your crystal. Again, and you think, well, okay. What I want to say in this kind of things, when you're in these situations, you'll often be intimidated from asking the questions. You need to keep on asking the questions. The whole theatre of these presentations are around them presenting something and then shutting down your questions, asking your questions. But you need to ask these particular questions. So, how do they do? Before we get on to that, how they did, I want you to look at something about I talked about projection and clothes. So which are the hedge fund managers and which are the tech titans? And what are they wearing? Who needs to impress anyone? Who needs to convince people? This is Mark Zuckerberg. Although I suspect we'll see him dressing up now. When I don't know who this could be Elon Musk, I'm not sure. But these people, they're all dressed in in suits anyway. But if you've really made it, then you don't need to. If you've convinced people, then you can afford to wear a Motorhead or something, t-shirt. Yeah, Motorhead t-shirt and watch denim jeans. So this is the character in The Billionaires, because you've made it. Everyone thinks you're good, so you can go around in a t-shirt. Okay, let's go back to these people. How do they do? Alan Sheen, the co-founder and chief investment officer. I'll bring out my black box if you show me your crystal ball. Down. The Dalton Street Absolute Return Strategy experienced its first calendar year in the history of the strategy. Our initial reaction to the first calendar was extreme disappointment. After all, we are an absolute return fund. Yeah. After more than 20 years of positive returns for this strategy, how could this happen? And this is the bit I find funny. As mathematicians, we know that the greater the negative returns and the greater the positive returns that will occur. It's just the basic of statistics. I don't know that it's the basic of statistics, but it's certainly the basis of finance. The higher the risk, the higher the potential return, but also the higher the losses. Now that's fine, that's true. But the point is, here's a hedge fund. He is promising an absolute return. There's not much point turning to the maths and saying, oh, this is all mathematically expected. You promised us absolute returns. So, and the other thing about this 20 years, they've only been in operation for 4 years. They had a strategy which they back-tested out for 20 years. So that's what they're saying. Now the thing about this is, when someone says we've back-tested a strategy out for 20 years, the thing you've got to ask them is, what about the other strategies that you back-tested and you're not showing us? How do they go? You're just showing us the ones that worked. But how do we know it's going to work in the future? It just might have been sheer coincidence it worked for the past 19 years. Okay. So it's tough to get a... Now, there might be some value in this. Maybe, if given the fees and everything, they might give you a return better than otherwise. They might have a high return for a lower risk. Okay, some other areas of where I think we will find modern portfolio theory is useful. So Robert Shiller says if there's a strange enthusiasm for Bitcoin, and he talks about it being a bubble, but then someone else says it's riskier to not invest in cryptocurrency. So I said soon the risk of not being involved will outweigh the risk of having a small allocation. A rational investor should have 1 or 2% of their portfolio invested in the blockchain disruption. And that's actually true. And I'll go why. That's why modern portfolio theory says it's actually rational to invest a little bit in this. Another one is gold. Another asset class is gold, how gold performs in a crisis. So you see that in the global financial crisis, it was plus 21%. The terrorist attack plus 2001, plus 6%. So gold is the kind of asset that you expect to have positive returns in a time of crisis. So that makes it an attractive investment. Basically, it is like insurance, which means that if it delivers in a time when you most need it, it's going to be expensive. In normal times, gold isn't going to deliver a positive return. Most of the time. Simply because other people will want it, because it's so attractive. It'll only pay off in an extreme event. So this is my colleague, Dirk Bauer, says why digital gold won't ever kill off the real thing. And another thing that might become, can be explained by modern portfolio theory is the property prices in Sydney and Melbourne. So ultra high net worth people have found Australia and they're coming here in droves. They're targeting residential homes, apartments in the already hot and Melbourne markets. Now, why would they come to Sydney and Melbourne if they're good cities, but they're hardly the most exciting cities in the world. They're coming because of these elements. They're stable politically and economically, and so this is again part of the diversification strategy. Okay, a quiz now. Getting into the theory. A high return, is it better than a low return? True or false? It's not a trick question. True, good. A high variance of return better than a low variance? Do you prefer a certain thing or an uncertain thing? You prefer something that's certain, usually. So a high variance is less attractive than a low variance portfolio. So we have two securities, X and Y. The Sharpe ratio is the expected return minus the risk-free rate. So that's the risk premium minus risk divided by the standard deviation. So we have a Sharpe ratio of security X is equal to 1.6. The Sharpe ratio of security Y is equal to 2. Which security would you prefer? Why? Why? Okay. Why? Because you get a higher return for a lower... The ratio of 2 is saying you get a higher return for a given level of risk. So security Y is better than security... You prefer security Y to security X. So rational risk-averse investors aim to maximize the Sharpe ratio of their portfolios, but the question is how to do this. There. So let's have a thought experiment then. We have 2 stocks, each with a standard deviation of 40% and expected return of 50%. So these are Ford Cars and Starbucks Coffee. What's the expected return to your portfolio if you have both? Joe. Thanks, Joe. 15%. Right. 15 plus 15 divided by 2, an equal weighting, 15%. So, will the standard deviation of your portfolio be greater or less than 40%? Now, if you bought Ford Cars alone, let's say you really like Ford Cars, and think, I'm going to just buy Ford Cars. So, do you lose out on expected return? No. You still get 15%. Starbucks Coffee, so you don't want that. But if you combine the two, if you don't have an emotional attachment to any either, but you combine the two, you get the same expected return, but will your standard deviation be 40%? Be less, yeah. Because sometimes when Ford Cars go up, Starbucks Coffee will go down. They're not perfectly correlated. So, having these 2 assets together gives you the same return, a higher Sharpe ratio for a lower risk. So it gives you the same return for lower risk, which increases the Sharpe ratio. So we should, now this kind of thing isn't, as I said, someone got a Nobel Prize, but you might think, well, that doesn't seem to be that kind of insightful. 1,500 years ago, people were saying a man should always place his money 1/3 in land, 1/3 into merchandise, and keep 1/3 in hand. This seems quite sensible, like a variation of don't put all your eggs in one basket. So this is ancient portfolio theory. I'm talking about how is modern portfolio theory different. So modern portfolio theory tells you, is a bit more precise than this. He says you should put everything in different baskets, but modern portfolio theory says actually you should pick investments that don't co-vary, that vary in the opposite direction. So rather than randomly selecting across different categories, or even putting an equal weight across different categories, pick assets that systematically negatively co-vary. So which stock, if you have 3 portfolios, 3 categories, General Motors, Ford, and Microsoft, they all have the same expected return. At the moment you just have General Motors stock. Which stock will be more effective? Microsoft, because it's more likely to be different. Right? So the covariance, the extent, price of issue, that move together. So investors should prefer, this is the insight, investors should prefer investments whose returns are expected to co-vary less with their existing portfolio. You love your company, you're working for a company. Let's say you're working for BHP. You've risen to a high position in BHP, you get bonuses, etc. You think BHP is a great company. You know a lot about BHP because you're working there and you read everything. You're just that kind of a person. Should you buy shares in BHP? What will your manager tell you? Why not? You know a lot about BHP. You love it. It's a great company. Other things being equal, the answer is no. You're over-invested in BHP. Unless you have some inside information about, and that's illegal to trade on that anyway, so that's out, so you can't do that. But otherwise, illegality aside, unless you have some inside information, that would be the only sensible reason. Otherwise, because you're already invested in BHP, it's better to branch out into another company. Rio? No, not Rio. Rio's too close to BHP in the same industry. Branch out into something quite different. So add assets whose performance is less than perfectly correlated with your portfolio. In fact, the less correlated, the greater the reduction in risk. If they're negative correlated, that would be ideal. So let's have a look at Greg and Karen. They plan to use their proceeds from a property sale to fund their retirements. They pulled their home off the market in Headland after just one viewer expected the house in over 3 months. This is what they did. There's a whole lot of risk in investing in Port Hedland. So if you're investing in Port Hedland, you're still subject to the risks of the Port Hedland economy. So you might be working, you're buying a house, buying property, whatever. All of this will depend on how well the Port Hedland economy is doing. So you can't diversify. However you invest in Port Hedland, you can't diversify out of that risk from being in Port Hedland. Now, if things go really well in Port Hedland, that's fantastic. All of your investments will go up. If they go down, all the investments will go down. So, what about Matt and Kate? Matt and Kate did really well. They took a high risk. They had a specific location, in this case, Moranbah. Where is Moranbah? I went to school in Charters Towers, which is somewhere around here, in the middle of nowhere. And Moranbah is pretty much in the middle of nowhere. So, if you want to take a high-risk strategy and invest in Moranbah, that could work. And if there's a demand for land in Moranbah, as it happened to be, because there was a coal mine that went through, you can pay off fantastically well. That's what Matt and Kate did. 2 years later, it collapsed. The economy collapsed. They lost their money. They appeared on 60 Minutes blaming the banks for lending them the money. They said, the banks shouldn't have lent to us. We didn't know what we were doing. It's irresponsible of the banks to have lent to us. And now they ended up owing pretty much a few $1 million. So they went bankrupt. So there's nothing particularly smart about this. They obtained knowledge from the right source, tapped into experience and decision making. You can't beat that. They just took a risk. And they lost. And I've got to admire them to go back onto 60 Minutes and then blame the banks. You know, happily took the Investor of the Year award. Then when things went south, they went and blamed the banks. No, we're just babes in the woods. We didn't know what we were doing. Yeah. So, this is one question you might ask is, if you're just in terms of the stock market alone, how many stocks do you need to invest in to diversify? So it turns out that if you're in the stock market, if you diversify across randomly, if you pick randomly, then by the 25th company, you eliminate pretty much all of the risk. This is where you've selected randomly across the portfolio. You can eliminate more risk more quickly by investing in assets whose returns are not correlated with the ASX. All right, we'll take a break there, come back at 9 o'clock.
Just one question, sir.
Sure. Okay, so Australians tend to invest, and this is the same all over the world. People think their own home country is less risky than anywhere else. So if you go to Japan, they think their home country is less risky than America. If you go to America, they think that it's less risky than the US, which means that investors tend to over-allocate their investments to their own country. And here you can see this could be a particular mistake. It's less of an issue for the US, which makes up something like 40% of the world market. But if you're in Australia, the share of GDP is just 1.15%. So this is a different map of Australia, or projection. And so investing in Australia alone, you're exposing yourself to more diversifiable risk than you need to. So just a summary so far. Modern portfolio theory is just a general theory on how to construct a portfolio to minimize risk. So the core insight, you need to add assets whose returns are uncorrelated with yours. And the risks that your assets share in common cannot be diversified away. So the greater the variety of assets in your portfolio, then the lower the portfolio's systematic risk. I'll show this afterwards in the thing, but let me go to derive how the capital asset pricing model came up. So let's say you've got two shops, a hot cocoa shop and an ice cream shop. And 50% of the years are cool, 50% of the years are hot. And when it's a cool year, as in the temperature-wise, then you have $100,000 profit, otherwise zero. In a warm year, you get $100,000 profit, zero otherwise. So the expected profit every year is either 100K or 50K, or zero divided by 2, so that's 50K. The risk-free rate is 5%. So a risk-free perpetuity of why or why not? So if you paid $1 million for the hot cocoa shop, what would your expected return be in a percentage terms? Your expected return would be 5%. Right? 50K over 1 million is 5%. If you paid 50K for the ice cream shop, the return would be 5%. Now, you can also buy a perpetuity, a risk-free perpetuity, say a government bond, that will pay you $50,000 for forever on $1 million. So that's the benchmark. You're comparing this returns from the cocoa shop and the ice cream shop against this benchmark. So would you pay $1 million for either shop? No, because you're getting the same expected return for more risk. Because you're getting either 100 or 0. And that's the variance that you don't like. I mean, you don't mind getting 100 every year, but there's no guarantee. Some years you'll get 0. And it's that variance that you don't like. So if you're risk averse, you will prefer, you won't pay $1 million for either. If you're risk neutral, yes. If you're risk neutral, it doesn't matter. You'll pay. So when I talk about rationality, this depends on your preferences. Someone who's risk neutral, it's perfectly rational to pay $1 million for each shop there. Okay, let's take the case of a risk-averse investors. So you have two shops and 4 investors. You have an ice cream shop, the same, hot chocolate shop, 100 cop, 0 otherwise, 50 per years. The risk-free rate is 5%. So if you buy the two shops together, you'll get, what's the expected return of buying the two shops together? You'll get 100,000. Because you'll get, it's either a cool year or a warm year, either way you'll get 100,000. So if you get 100,000, then the cost of the two shops together is $2 million. How much would an investor pay for each shop? Let's say investor A buys the ice cream shop alone. Will they pay 2 million, 1 million, or less than $1 million? They'll pay less. Investor B buys the chocolate shop. Would they pay 2 million, 1 million, or less than $1 million? They'll pay less than $1 million, if they're risk averse. The sum of the price paid by both A and B is less than 2 million. But investor C buys both shops. Investor C buys the ice cream shop and the hot chocolate shop. Investor C is guaranteed a return of 100,000 every year, whether it's cool or warm. So investor C will be willing to pay as much as $2 million. Because the $2 million gives investor C a risk-free rate of 5%. Now you might think, so what? The so what in this is that in a competitive market, who do you think will be, what will the price of the asset be? Will be valued on the basis of its diversifiable risk, its non-diversifiable risk, not its diversifiable risk. You can diversify away all of the risk from the ice cream shop and the hot chocolate shop by buying them together. So someone who goes into this market and is buying only one shop will have to pay more than they need to. They'll be paying to get an inferior return for the amount of risk that they're taking on. That's the intuition. So the shop's price will not reflect the individual business risk, but their zero risk as a portfolio. So in a rational market, investors, the risk of an asset isn't its absolute risk, but its risk relative to how well it moves with the other assets in the portfolio. That's the relevant risk of it. That's what modern portfolio theory says. Okay, let's go now to the applying modern portfolio theory, just to give you some implications, what issues and evidence. Invest in what you know seems a sensible rule. So someone says, invest in what you know. Unless you understand the company's products, market, competitive strengths and weaknesses, you won't be able to project the future cash flows. And this is what Warren Buffett thinks as well. He invests only in things that he understands and knows. On the other hand, you have Russ Kostrich, Managing Director of BlackRock's Chief Investment Strategist. He says, invest in what you know is seriously flawed advice. Who's right? And why? Now notice that Warren Buffett also says to people, invest in an index fund. In fact, he says most people shouldn't be in the investment business. So Warren Buffett is right in his, as long as you're confident you can spot assets that are undervalued relative to anyone else. So if you think you can identify an undervalued asset, and over your investment horizon, the price will revert to what you think it's the correct price, then that's good advice. Invest in what you know. And here, presumably, you understand the company's products, markets, and competitive strengths. But if you're not confident, and the vast majority of evidence suggests there's no reason for you to be confident, then don't invest, don't restrict yourself to invest in what you know. You're exposing yourself to a lot of diversifiable risk for which you won't get a reward. So, Bill Gates, the world's richest man for most of the last 25 years. Right now it's Jeff Bezos, and his wealth was $94 billion after giving away at least $38 billion. Does he invest in what company do you think Bill Gates knows the most about? Probably more than anyone else. Microsoft. He founded it. But does he invest in it? No. Less than 20% of his portfolio is in Microsoft stock. The other holdings are in Canadian National Railways, Berkshire Hathaway, Deere & Company, Liberty Global, Waste Management. He invests in a diversified portfolio. As a matter of fact, he would have done better if he stuck to just Microsoft. But he knows that's out of his control. A whole lot of things happened that he couldn't, went right for Microsoft. So I think he sleeps well enough at night. So the shares, and you can see, so Mr. Larson's has delivered a compound annual return this is back in 2014. But these aren't extraordinary returns, these are just normal returns. He would have done better if he invested in the index, the market index, even. So this is going back to some years. Do you have a stock market competition now? Every year there's generally some kind of stock market competition where you invest a hypothetical sum. Now if you want to win this stock, what you need to do is take a very concentrated portfolio. Don't diversify. Diversification is a bad strategy for this kind of a competition. What you want to take is a very concentrated sector, a small sector and invest all your money in that one. Now, you have to decide which of those sectors is likely to have a chance of doing really, really well. So, as you see, he created a small number of stocks with very volatile prices, leveraging significantly, investing in a single industry to increase the beta of his portfolio. So that's exactly what you need to do. It's not his money, it's not real money, it's a high risk, but there's not much point in coming third or fourth or beating the index. What you need is to beat everyone, and the only way you can win that is by taking a high-risk strategy there. This, the other one, other issue we'll look at is why people keep on investing in underperforming hedge funds. So we see here that hedge funds trailed the stocks for fifth year with 7.4% return. The Barclays hedge fund returned 2.8%, the Standard & Poor's index returned 13%. This is in 2015. And they said investors forgive weak hedge fund returns, and yet big institutions are planning to send them more money this year. How to explain this puzzle? Well, in a way, what does this tell you about the correlation between the hedge fund and the index? They don't appear to be very correlated. So it makes sense to have some investments in the hedge funds, precisely because they don't always beat the market. So they seem to be negative correlated to a degree with the index. So is it a good decision to invest in hedge funds? As I said, yes, it's a sensible decision to have at least some of your money investing in hedge funds. And again, how much to invest in exotic markets, sort of overseas equities, hedge funds, private equity funds? Now, this is a more difficult question because exotic investments are those that have uncorrelated returns to mainstream investments in normal times. So in normal periods, their returns are uncorrelated, so they result in a whole lot of diversified risk. They result in you diversifying away a lot of your risk. But the thing about an exotic investment, because it's in an exotic location or an exotic market that you can't get to, they have low liquidity. It's hard to find another buyer, almost by definition. So it's hard to sell at short notice without giving a substantial discount. Now, in a normal period, when the market things are going well, you don't need to sell in a hurry, so that really doesn't matter. But in a period, in an economic of crisis, that's when you might want to sell, and that's where, just when you need the benefits of diversification the most, you don't get it. So the increase in volatility from the exotic investments then will often outweigh the benefit of lowering the diversifiable risk. So you don't want to, you just want to have a small allocation, not a substantial allocation in these exotic investments. So one reason why you might have why you might invest in a hedge fund isn't because you believe that they promise that they will give you good returns all of the time, but because they'll give you access to an investment class which you can't otherwise access easily yourself. So this is simply what they're known as smart beta. But the sensible way to look at a hedge fund is to say, I don't expect it to outperform. I really don't believe what they're saying, but I still will give them some money because they will give me access to an asset class which is uncorrelated with my mainstream investments. And over a long period of time, that will result in a more diversified portfolio. Which is why I was surprised when I read this article the other day, and which is why people are now might be moving the money out of hedge funds. You can see that Goldman Sachs said the top 10 holdings on average, these are the hedge funds, made up 70% of a fund's long portfolios, the ones that they're expecting to outperform in the long run. So it's Amazon, Microsoft, Facebook, Alphabet, and Alibaba. Now, the thing about these is that these aren't particularly exotic. These are just funds, stocks that you and I can get into. So if a hedge fund is allocating up to 70% of its assets over here, it's not adding any value to you. In fact, it's not even outperforming the market, most of it. So a hedge fund that invests in these plain vanilla stocks, mainstream stocks, is really wasting your money because you could do the same directly. So we'll look at modern portfolio theory and have a look at Melbourne and Sydney property prices. This is a little bit out of date because Melbourne and Sydney property prices we know have come down, but so they say London and Hong Kong are most at risk of a housing bubble, but Sydney's creeping up in terms of having the most overpriced property in the world. Melbourne is the country's most overvalued market, and so it looks like they were right because it's now the value's coming down. But the question here is, why are overseas investors interested in Sydney and Melbourne if property is so obviously overvalued? It makes sense. They're not particularly interested in getting the returns, but they're interested in these assets as diversifying from their own investments in their own country, which makes perfect sense. Australians tend to be over-allocated to Australia, but in other parts of the world where they think they're over-allocated to their own country, they're looking to diversify by investing in relatively accessible markets. So while it might appear overvalued from a local perspective, from a foreign perspective, it makes perfect sense because they're getting the benefit of diversification, lower risk, and in exchange they don't mind a lower return because they're making the trade-off to diversify their portfolio. So just to point this out, so you can see that Australia is a safe haven for the investments as investors steer clear of volatility elsewhere in the world. So what is a safe haven then? A safe haven is an asset that is uncorrelated or negative correlated with another asset or portfolio. So this is particularly in times of market stress or turmoil. So from a perspective, from an overseas perspective, they might think, oh, it's overvalued. We won't be getting a lot of rental income. But just if there's a political turmoil at home or some other trouble, we expect it to be able to pay off at that time. We'll be able to have some of our assets in a reasonably safe, stable economy. And it makes sense from that perspective. So Philip Ruthven has said, as we know, gold is no longer used for currency backing. It says for two purposes, use in jewelry and as a panic metal during financial crises. And you have a look at gold versus stocks. Gold prices fell 28% last year, while the S&P index returned 32%. But investors who bought gold in late November 2004 would have done better than those who purchased stocks. So gold has climbed about 157% over this period, while the S&P is up 137%. That period included the financial crisis. So when the financial crisis hit, stocks would have plunged, but gold would have retained its status because it's a panic investment. In a time of crisis, people buy gold. So my colleague over here has looked at, Dirk Bauer has looked at gold, and he says, gold is like an insurance. The way to think of gold is, in a normal time, it won't pay off, but in a time of stress, economic turmoil, that's when it pays off. And so that's what he means by gold is a safe haven when it's needed the most, but it's not a safe haven. It's not supposed to be in a period of rising stock market. It's like your insurance. You're paying insurance all the time. You're losing money, but you're fine with that. You expect it to pay off when you get into an accident or get injured or something. That's when the insurance pays off. So these are reports on the death of modern portfolio theory. They say why modern portfolio theory is frozen in time. So people say that modern portfolio theory hasn't worked. We've had the stock market crash. So people have diversified their assets, but it doesn't seem to have helped them from protect them from market crashes. But the thing about modern portfolio theory is that it's only as good as the statistical models. So the problem is that the historical correlations with assets aren't necessarily constant over time. And so because they're not constant over time, it makes it very difficult to identify what is the optimal portfolio before time. So that isn't a problem with the theory. It's just a problem with our ability to estimate the correlations, the future correlations between different categories of assets. So Harry Markowitz then looked at this and said, does portfolio theory work during a financial crisis? As they said, diversification won't protect you against factors that affect the whole market. In a time of financial crisis, systematic risk swamps the individual risk. Holding concentrated portfolios doesn't necessarily help in a time of crisis. It depends on what kind of assets you're concentrated in. So in the global financial crisis, US Treasury bonds and cash portfolios had a positive return. US equities had a substantial negative return. There. So here, this is the trade-off you have to make. Do you want to hold cash or US Treasuries all of the time? They provide liquidity, but also lower returns. There. So as I said, the problem is not so much with the theory, but with applying the theory, with identifying the covariance and the extent to which the covariance is stable or changes over the particular period. That's the issue. Okay, another book, a book I'd recommend that you read is Nassim Taleb. So if he talks about the hidden rule of chance in life and in the markets. Again, this is one of those things where you won't find him in many finance lecture courses, but and he has a very scathing view of academics. In fact, there's a scathing view of everyone, really. But still, the book is worth reading. So if you're interested in this, then I recommend this book. Okay, I'm running out of time, so I'll leave this there for now. I just want to identify the right mix or allocation. This question is a matter of judgment. So how much should you invest in equities? How much in bonds? So as you know, we're in a period of historically low interest rates. And so people are now, back in November 2016, people are asking, is this now time to go back into equities? So people are invested in the bond market, but maybe it's time to get out of the bond because we can see inflation coming. So the year before, we said interest rates can't stay low forever. History says it's too little too late. So this is Christopher Joy saying they've left the interest rates too low for too long. But then this week we find out that the market interest rates are going even lower. So long-term bonds have plunged below short-term ones, which is a predictor, a suggestion that people are buying long-term assets because they believe long-term bonds and driving up the price because they think there's a recession coming. So, back then, people were thinking, is it time to turn from bonds to equities? And yet here we are today thinking, no, the market can go even lower yet. So there's no way of getting this right. It's really, really difficult, is the point. What's the right approach? Maybe the simple one is the most effective. So a researcher in the Rand Corporation was wondering how much of his retirement fund to allocate to stocks, how much to bond. So he's one of these mathematicians. So he said, I should have computed the historical variances of the assets and drawn an efficient frontier. But he decided, no, I'll just invest 50% in bonds, 50% in equities. I'll do it. And that turned out to be Harry Markowitz. So even someone who wins a Nobel Prize in economics for modern portfolio theory doesn't use anything but a fairly simple rule. 50% bonds, 50% equities. And so, appropriately enough, given that gave us modern portfolio theory, the password for today is Harry. For your quiz. Oh, God. No, this is from last week. I wanted to, thanks for reminding me. This is, there was panic there. Question 5. I'm going to give you both correct, true, and false. I didn't talk much about Jeremy Siegel, but Jeremy Siegel recommended stocks in the long run because equities are less volatile than bonds. Because in the long run, stocks are a better hedge against inflation than bonds. That's why. So in the short run, you're better off. Ash. Hi.
No, I'm going about them coming back.
Oh, okay, right, sorry. I'm going to try something here. That worked.
Ladies and gentlemen, the auction will begin shortly. Please take your seats.
Art and money have always gone hand in hand. It's very important for good art to be expensive.
$16 million, $17 million.
You only protect things that are valuable. If something has no financial value, people don't care.
People are very seduced and it just becomes about the money.
Bubbles make beautiful things. Keep it floating. Don't burst it.
What is it that makes a piece of art worth 10 million, 20 million?
Great things tell you they're great.
It moved me so much.
There are no rules about what is going to be good and what is going to be bad.
Because art is art.
What's more important, art or life? The auction will begin shortly. Please take your seats.
Art and money have always gone hand in hand. It's very important for good art to be expensive.
$16 million, $17 million.
You only protect things that are valuable. If something has no financial value, people don't care.
People are very seduced and it just becomes about the money.
Bubbles make beautiful things. Keep it floating. Don't burst it.
What is it that makes a piece of art worth 10 million, 20 million?
Great things tell you they're great.
It moved me so much.
There are no rules about what is going to be good and what is going to be bad.
Because art is art.
What's more important, art or life? I would say art, because at least it lives forever.
I really never made any money until recently.
They tried to make it like the best artist is the most expensive artist. How could it be true?
The art world is a very brutal place.
Is it absurd? Yes.
At $30 million. So to you, thank you very much indeed.
There's a lot of people that know the price of everything and the value of nothing.
So you started out as an abstract painter.
I was painting a little bit, doing these kind of Mondrian-like paintings. I liked it because it seemed accessible to me. I felt I couldn't draw. I always felt that maybe that was a handicap to me. When I saw Mondrian and stuff like that, I could do that.
See you next week.
Let me put it that way. And then I took my paintings and came home during the second year summer vacation and decided to exhibit them downtown in the Washington Square Art Show. And I set my paintings up, right, and the guy next to me, after